Hello, everybody. Welcome to today's episode of the Daily Dose. Today's Thursday, November 10th, and wow. Almost left completely speechless after what happened today. What do you even say after what happened today? Obviously, today was historic. The stock market rose by the most it has since April of 2020, so when we were coming out of that COVID pandemic. I'm not even gonna lie, I didn't see this one coming. Even if we got a slightly lower CPI print, I wasn't expecting this. So the expectation for the CPI was 7.9, and it came in at 7.7%, and the market really cheered that. They're obviously predicting that inflation has peaked and that the Fed won't have to be as hawkish. That will be closer now to peak interest rates. It's a good data point, but it's only one data point. So you don't want to get overly excited even after a day where the Nasdaq's up almost 7.5% in one day. I mean, the S&P 500 was up 5.5%. The Dow Jones up 3.7%. I mean, it's hard not to get overly optimistic after a day like today, but you have to be realistic. It's just one data print. Inflation is still 7.7% year over year, and that's 5.7% over the 2% target. So, you have to put things in perspective a little bit. Today was good though, so definitely don't ever want to. Definitely not against making a lot of money, which a lot of people made a lot of money today. So let's take a look here. So U.S. stocks posted outsized gains Thursday, logging their best one-day climb in 2 years, as Wall Street cheered lighter than expected inflation data and monitored midterm election tallies. The Consumer Price Index for October reflected a 7.7% increase over the last year and a 0.4% increase over the prior month. That's better than Wall Street expected. Economists surveyed by Bloomberg called for a 7.9% annual rise and a 0.5% monthly gain. Moderations in the data again fueled bets that the Federal Reserve may ease the pace of its monetary tightening campaign, with investors shrugging off Chair Jerome Powell's assertion earlier this month that a policy shift is not imminent. Remarks by the Federal Reserve Bank of Philadelphia President Patrick Harker also suggested Thursday that officials may be nearing a pause. And while that's all great and merry, we've seen the market in this bear market rally and betting that they're going to get something from the Fed, and then the Fed does something else and is more hawkish and it crashes. Obviously, this time is different, and that's a dangerous thing to say, but obviously this time is different in the sense that we actually are getting good inflation prints that's coming down now, but we still haven't got that concrete. Until I hear it come out of Jerome Powell's mouth, I'm not going to bet money on him pivoting. You can't do it because the market goes down 3-4% in one day when he talks. So that's the only thing you kind of have to keep in check. But yeah, it's true. We got remarks from the Reserve Bank of Philadelphia saying that they might be nearing a pause. Obviously, the CPI coming down is a good thing, but it's still at 7.7%, and that's not sustainable. We can't live life like that. So they still have to get it down. It's good that it's coming down, but they have to push it lower, a lot lower. And it might be harder to get it to 2% than it is to get it from 8% to 7.7%. So still a long road ahead, but today was a good day. Definitely a good day. The S&P 500 rallied 5.5%, its biggest intraday gain since April 2000, while the Dow Jones Industrial Average jumped 1,200 points, or 3.7%, the most since May 2020. The technology-heavy Nasdaq advanced a whopping 7.4%, its sharpest climb since emerging from the pandemic crash in 2020. Meanwhile, Treasury yields tumbled following the report, with the benchmark 10-year note falling well below the 4% level. So a lot of indicators that we haven't seen since coming out of that COVID pandemic, that huge crash, which is a good sign of if you're of the belief that we've bottomed. I mean, these are all very, very good signs. Again, you have to be careful with the Fed, but this could be the beginning of something. I'm not here to just crap all over the parade. So Sharp gains were seen across technology stocks, with Apple and Microsoft each up more than 8%. Amazon shares surged 12%. Meta was up 10%. And Nvidia was up 14%. So a lot of gains in riskier assets. It wasn't the Dow Jones leading today. It was the Nasdaq by 4% over the Dow. I mean, just crazy stupid numbers today. Crazy stupid. So let's take a look at the S&P 500. We blew through the bottom of this zone. We're still in it. If there is selling pressure, I'd expect it around the 3980 or even the 4,000 is like a psychological level. And after the 4,000, and we've got the 200-day moving average. So let's just say that we come up to this 200-day moving average now on the S&P 500. If we break through the 200-day moving average, that is huge. That is not something to be ignored. I had a chart in one of my weekly episodes a couple weeks ago, maybe a month or so ago, where we showed when the S&P 500 is below the 200-day moving average for a long period of time, and this would be considered a long period of time, and then it breaks through, it's usually a sign that the bottom has already been in, that the bottom is in. That would indicate that this down here was the bottom. And, we're kind of in this little uptrend right now, which we've been in before, and then Powell talks, and then we go back down. But, it's hard to argue with what happened today. So I do think that the next CPI print and the next time Powell talks will be very telling. The FOMC in the beginning of December will be very telling, obviously. We're moving into a time period in the year, especially after midterm elections, where the stock market historically performs very well. And, until the FOMC meeting, I don't know what could slow down this market besides technical things like the 200-day moving average and our trend line, which obviously are very, very, very big indicators to this bear market and where it's at. But I do think that Powell could turn that around if he comes in and says, we're still raising interest rates at the pace that we said last month. And even though we got one good inflation print, it's just one data point. We need to see more. He could very well say that, and the market would probably tank, especially if we keep rallying from here. But if this is sufficient enough for the Fed to say we're going to slow down the pace significantly of at which we're raising rates, and maybe there will be a pause soon. Not to say that they won't raise later, but maybe we're going to pause right now and see what happens with the inflation data because we don't want to hike too fast. Then this market could definitely keep moving up. So, yeah, really, really interesting day. You don't see days like this too often on the stock market. And we're about to move into Bitcoin, which, was just as surprising. So we'd been in this range for months. We talked about this level every day. It finally broke through, and it looked like we were heading towards our $12,000 target. And all of a sudden, the CPI print came in. The market is up 5, 6, 7%, and Bitcoin's up 10%. So what's really interesting now about Bitcoin is it's right at the bottom of this zone. It's back above the 17.7, the 17.5, the levels that we talked about were so important. And, the next couple of days are going to be really interesting on Bitcoin. I'm super interested to see what will happen because I didn't see this coming. I won't lie. I didn't see this coming. I did not expect for Bitcoin to be able to rally this strongly, even with the market rallying after it had broken through this zone. So while Bitcoin is susceptible, if we do sell off in the next couple of days after this huge up move, it is looking not as bad as it was yesterday. It was looking pretty dire yesterday. It looked like we were moving pretty rapidly down to this next zone, and that wasn't the case. So Bitcoin is in a state of flux, I'll say right now. There's a lot of different things that could happen here, a lot of variables in this market that can affect it right now. You got to be careful. You have to have a plan. But honestly, this is why I said you just keep dollar cost averaging and you keep buying in because you don't know when this is going to happen. You just don't. And you have to be ready for it. If you missed a 7.5% up day on the Nasdaq, you missed it. And it's not going to happen again for a long time. This is the first time it happened in 2 years. And before that, I don't know the last time that it was up 7% in one day. So, that's why you buy and hold in your long-term accounts because you can't afford to miss out on these days. I'm sure the rest of the week, the rest of the month, the next couple months will continue to be volatile, but this was a really interesting day, a big day. I definitely don't want to just seem like I'm kind of bringing in bad news and just being that perma bear. Like that's not what I'm trying to do at all. I'm just trying to be prepared. So again, huge day. I'm going to leave it here. If you like this content, please subscribe on YouTube, follow us wherever you listen to podcasts, and stay tuned tomorrow and over the weekend. I'm sure there's going to be a lot of action the next couple of days now, a lot of speculation. I'm interested to see where things go from here. You should be too. That's why you should stay tuned. I appreciate you watching or listening to this episode. And until next time, thank you for listening.